Good morning and welcome to our webinar. Today we'll be focusing on the important topic of planning your retirement requirements and optimising your tax position. We will be recording this webinar, so if you would like to rewatch it or share the recording with any of your colleagues, friends or family, you can visit our website, grosvenorwealthmanagement.co.uk, and watch the recording. I'd like to introduce myself to you all. My name is Joshua Lloyd-Jones. I'm the Marketing Coordinator here at Grosvenor Wealth Management, and I'll be your host this morning. We're open to all questions from our audience today, so I encourage you to please submit any questions you have to our speakers. You can do this by entering them in the Q&A box on the GoToWebinar menu, and we'll answer them during the session. As I previously mentioned, we'll be covering the retirement planning process from a financial planning point of view and the multiple tax implications of retiring. Now, to break these points down further, we've got our two panelist speakers. We have Marina Trinchese from Rayner Essex to discuss the tax implications of retiring and making the most tax efficient savings. To give you all a bit of background on our guest speaker and her company, Marina joined Rayner Essex back in 2017. She advises on all areas of private client tax, having spent part of her career in expatriate tax services and advising internationally mobile signees on their UK tax status. Marina has a keen focus on non-resident and non-domicile matters. Rayner Essex are an established chartered accountants firm based in St Albans in central London. They specialise in providing accounting and tax solutions to their range of multi-sector clients. We also have Prem Shergill from Grosvenor Wealth Management. To give you a bit of background, Prem is an experienced diploma qualified financial advisor and joined Grosvenor Wealth Management in November 2017. She reviews clients' financial plans to ensure that they are meeting their needs, whether it be personal or business protection, investments or pensions. Prem focuses on building trusted and lasting relationships and works closely with her clients to help them to plan for their futures in the most tax-efficient way to help achieve their long-term goals. Based in Hartland and central London, Grosvenor Wealth Management work together to deliver the highest standard of service to meet our clients' ever-changing needs. We offer our clients a range of services including wealth management, investment, retirement and inheritance advice through a team of highly experienced and professional independent financial advisors. Before we start this morning, I'd just like to point out that Grosvenor Wealth Management Limited is authorised and regulated by the Financial Conduct Authority. What will be discussed during the webinar is strictly general information guidance and is not intended to constitute investment, tax or legal advice. Tax is down to personal circumstance and may be subject to change, and of course, we recommend you seek independent financial and accounting advice should you require it. Grosvenor Wealth Management and Rayner Essex are specialists in our respective fields. Our like-minded organisations recognise the need for accountants, tax specialists and wealth managers to work together and provide the appropriate and bespoke support for our clients. So on that note, I'll now hand over to my GWM colleague, Prem Shergill, to share her insights around pensions and retirement planning. Over to you, Prem.
Thank you, Josh. And I will begin with the latest budget announcements from the government that affect pensions, which are pension tax administration, low-earning individuals, total taxable income below the personal allowance, pension scheme migration, inflation position for the next couple of years, what should I be doing, and in certain times, what should I be doing with my pension? Retirement has changed. So state pensions as we know it was introduced in 1948. An average retirement lasted 2 years. Worked 50 years, retired for 2 years. Now we retire at age 66, which is set to rise to 67 between 2026 and 2028 for state pensions. On average, males are expected to live to age 85 and females are expected to live to age 87. On that note, we work for 45 years and now retire for maybe 20 or maybe even 30 years. Types of pensions. We have the state pension, which is based on national insurance contributions. We have the defined benefit pensions, which are known as occupational pensions schemes, and final salary, which are employer and employee contributions based. And we have the defined contributions known as occupational pension schemes, personal plans, money purchase, personal pension plans, and state invested personal pensions, again based on employer and employee personal contributions. Types of pension. So there are three different types of pension. One is the flexible option, which is your guaranteed and fixed income from state pensions, final salary benefits, and lifetime annuities. We have the middle ground, known as a third way, which could be on the basis of a temporary annuity, which offers some guarantees and some investment element. Then thirdly, we have the flexible option, known as the drawdown. Type of death benefits on pensions. So if death occurred pre-75, the lump sum or the income would be tax-free. If death was post-75, the lump sum and the income could be subject to a maximum income tax of 45% or the beneficiary's tax rate. How? So the lump sum income or taken over as a pension could be by anyone. An example of pension inheritance tax. So on my death, my partner can use my pension to provide an income tax-free if I die before 75. On his death, our children can use my fund and theirs to provide an income tax-free if they die before 75. On their death, our grandchildren can use my fund, my partner's fund, and my children's funds to provide an income, as can our grandchildren and our great-grandchildren, and so on. So it's essentially like an asset. It's not liable to inheritance tax. It can skip a generation if you like, and anyone can inherit: best friends, sibling, next-door neighbour, and so on. Drawing tax-free cash. Currently, it is in a tax-free environment. If you take it, you can reinvest it, which is likely to be in a tax-free environment. If you spend it, it's a very good reason for taking it. Or you can take it in instalments as a tax-free income, and that can reduce your final salary pension when taken. Ways of drawing your pension. There are several new choices following change to government introduced a few years ago, known as pension freedom. You can get a guaranteed income for life, a lifelong regular income, also known as annuity, provides you with a guarantee that the income will last as long as you live. Annuity rates are not that great right now, and also once you've bought an annuity, you won't receive any further investment growth. But it is a good option if all you want is a guaranteed income, and the older you are, the higher the income. A quarter of your pension can be taken as a tax-free lump sum, and any other payment will be taxed as the income tax rate. If you're in poor health, you could receive an enhanced income. You can get a flexible retirement income known as flexible access drawdown. This is a type of retirement option. You can leave your money in a pension and take an income from it. Any money left in your pension pot remains invested, which may give your pension pot a chance to grow, but it can go up as well as down. A quarter of your pension can usually be taken tax-free, and any other withdrawals will be taxed whether you take them as an income or as cash lump sums. You may need to move into a new pension plan to be able to do this, and you can draw a tax-free lump sum and choose not to take an income until you want to. Alternatively, it may be possible to take a part of your tax-free cash over time as a tax-free income. You can take your whole pension pot as a single cash lump sum. You can take your whole pension as a single cash lump sum, but be aware, although a quarter of your pension can be usually taken tax-free, the rest will be taxed. This may affect the amount of tax you pay on any other income you receive. Also, although you may receive a lot of cash in one go, you'll need to think carefully about where your income will come from for the rest of your retirement, and don't rely on the state pension. If you opt for flexi access drawdown, you can leave your money in your pension and take lump sums from it as and when you need it. Until your money runs out or you choose another retirement option, you can decide when and how much to take out. Any money left in your pension pot remains invested, which may give your pension not a chance to grow, but it could go down in value too. Each time you take a lump sum, normally a quarter of it is tax-free and the rest will be taxed. You may need to move into a new pension plan to be able to do this. You can also choose to take your pension using a combination of some or all of the options over time or from the outset. If you have more than one part, you can use the different options for each part. I'm now going to share with you the most commonly asked questions and answers around pensions and retirement planning I get asked by my clients and contacts. Do I have to stop work to draw my pension? No, not at all. In fact, you could consider continuing to work, perhaps reduce days and draw an income top up from your pension. And that way you could ease into retirement. It also means you're not having to draw your pension all in one go. Are there any disadvantages to taking pensions flexibly? Yes. Firstly, your income won't be guaranteed. It will depend on investment performance, and you could lose money which you could ill afford to lose. But there again, the reason for continuing to keep your money is to give it the opportunity to grow and therefore provide more income and for it to last, most importantly, longer. Also, if you draw pension flexibly, you may trigger a lower level of annual allowance, which limits future contributions to £4,000 per annum. Should I be worried about inheritance tax on my pension? No. Pension money, which is remaining in your plan, would not be subject to inheritance tax. Would be beneficiaries pay tax on any of the benefits if I died before drawing all of my pension? If you die before age 75, then there would be no tax for them to pay. If after 75, then they would pay tax at the highest rate of income tax, which could be up to 45% on any other benefits they receive. Or they could keep the pension going, effectively by you nominating them to take over your pension. So looking forward, what should be contained in your financial plan? Number one, financial plan goals. The importance of defining your goals is to provide a target for orientating your plan. After all, you don't hop into the car and just start driving without knowing where you're heading. Creating goals can be daunting. Keep it simple and understandable. Take some time and capture your thoughts on paper. Once you have a list, organise your goals chronologically. Next, prioritise and place focus on what matters the most to you. These objectives change over time, so visit your plan frequently to make sure it keeps pace with the changes in your life. Number two, make rough cash flow projections. Cash flow projections analyse the various what-if questions that arise. For example, what if I retire to a certain age? What if I spend this much during retirement? Is my investment strategy consistent with my spending needs? And can I afford long-term care coverage if I need it? While no one can predict the future with accuracy, it's very helpful to test your plan, its assumptions, and ability to withstand unexpected events. Cash flow projections test these various scenarios. Through this process, you'll discover that the various components of your plan are connected. For example, your investment strategy can be directly impacted by your income needs or the length of time until retirement. Number three, assess your risks on an ongoing basis. Risk comes in many shapes and sizes. For example, will your money last? How can you pay for your children's university fees and save for retirement at the same time? How will you cover your long-term healthcare costs? Some risks can be addressed through various forms of insurance. Others can be addressed as a part of your plan through savings, investment strategies, and basic planning techniques. While the events we worry about may not come to pass, it is important to incorporate risk management as a part of your plan. Number four, define an investment strategy based on the factors above. Your investment strategy is very important. In many ways, it is the embodiment of your financial plan. A good investment strategy reflects the goals you're trying to achieve. It's consistent with the withdrawal needs and the time horizon outlined in your cash flow projection. Lastly, it balances the risks you're willing to accept as an investor with the return you need. Number 5, review and refine your plan regularly. Really important. Remember that financial planning is never an ending process. It changes as your life changes. During times of high volatility in the stock market, it is helpful to remember that you have built a sound foundation through planning. That's all from me this morning. Thank you very much for listening. If you have any questions, please don't forget to answer them in the Q&A function of the GoToWebinar. I'll now hand you over to Marina Trinchese from Rayner Essex to share her insights around optimising your tax position. Thank you.
Hi, thank you, Prem. Sorry about that. We had a slight unmuting difficulties. So firstly, I do apologise in advance. I'm slightly full of colds today. It's not COVID, I promise you. I'm hiding at home anyway, but I do apologise if I start having a coughing fit. I will do my best not to for you. So leading on from Prem's session, I'm going to talk you through the tax side of retirement and what you should be thinking about if you are planning on retiring in the next 5 to 10 years and how you can optimise your tax position. I think it's fair to say that we all look forward to retirement, no matter at what stage in our careers and working lives we are. After a lifetime of hard work, you can start to plan to spend your time in a completely different way, whether that be traveling the world or taking up a new hobby, spending more time with family and friends, and there's plenty to think about. From a tax perspective, in some cases, retirement can be as straightforward as completing your final day at work and never looking back, but that won't be the case for everybody. So planning for your retirement, and certainly from a tax perspective, can leave you with the peace of mind that you won't be left with any unexpected tax liabilities or nasty surprises further down the line. The level of planning won't be the same for everybody, as each individual circumstances will differ. So what I thought would be helpful today is if I share with you the 6 questions I'm asked most frequently by my clients, which hopefully will apply to all or most of you, and just take you through what my advice would be for that. So question number 1, will you still pay tax once you retire? Unfortunately, yes. Once you retire, you do still remain liable to tax on your income, and this does include pension income, so private pension and state pension. It is a common conception that people think that the state pension is tax-free, and I think that's purely because it is paid without any tax being paid off, any tax being taken off, but unfortunately that's not the case. Most people find that their tax bills do decrease once they retire, as the income tends to drop, and individuals may even move to a lower rate tax band. So for example, they may move from a 40% tax band to a 20% tax band. Just to give you a couple of quick facts, if total income that you receive during a tax year is less than £100,000, you are entitled to a tax-free personal allowance, which is just over £12,500 at the moment per tax year, and the first £12,500 of income that you receive is not subject to tax. After that, your income is taxed at 20% if your income falls within the basic rate band, so that's up to £37,700. Any income between £37,700 and £150,000 is taxed at 40%, and any income over £150,000 is taxed at 45%. So quite steep tax rates once you get to the higher level of earnings. There are slightly different rates for dividends, and there are various other allowances such as a £2,000 dividend allowance, savings allowance of up to £1,000, and what's known as a starting rate for savings income. So worth looking at the sources of income that you do receive and making sure that you do make the most of the reliefs and allowances that are available. The rates do change every year. We are always hopeful that the personal allowance will go up every year, and normally it does. So these are the rates and allowances for 21-22. They will change in future. Question number 2 is, what about national insurance? You stop paying national insurance once you reach state pension age. So the golden questions are, what is the state pension age and how much state pension will you receive? As Prem mentioned earlier, the state pension age is currently 66. However, this is increasing and unfortunately we can expect to work for longer. In terms of your state pension, what you will receive depends on your national insurance record. The current full level of state pension is just under £180 per week, and that's based on you having contributed for 35 years. Class 1 and Class 2 national insurance cease to be payable when you reach state pension age, and Class 4 remains payable until the end of the tax year in which you reach state pension age. You do need a full contribution history to be eligible for the full state pension. So what is actually worthwhile doing is to check that there are no gaps in your contribution history. And you can do this by contacting HMRC. They do have quite an useful online tool where you can fill in your details and they will send you your contribution history. If there are any gaps, you can pay additional contributions now to protect your entitlement to the full state pension once you do reach state pension age. Question number 3, will you need to continue submitting tax returns to HMRC? So this again very much depends on your individual circumstances and whether you meet the self-assessment criteria that are set out by HMRC for a particular tax year. If I give you a couple of examples to put this into context, if your tax affairs are straightforward and perhaps you only receive pension income plus a little bit of bank interest, it's unlikely that you'll need to submit tax returns, but you should check that your pay-as-you-earn tax codes are correct. And this is so that you can avoid any over or underpayment of tax from your pension income, basically just to make sure that the correct tax is collected each month before the pension income is paid over to you. If your affairs are a little bit more complex, perhaps you receive any untaxed income such as rental income or self-employment income, investment income, perhaps you sell assets, receive foreign income, or maybe you're even non-UK domiciled, you will need to continue submitting tax returns. And in that case, I would suggest that you discuss your circumstances with your tax advisor and they'll be able to advise you further. Question number 4, if you are lucky enough to consider retiring abroad, post-COVID, obviously, what should you be thinking about? So pre-COVID figures actually show that around 400,000 people left the UK each year to start a new life abroad. And if you are thinking of doing the same, just a couple of things to watch out for before you leave. In the UK, your UK tax position is determined on your residence status and your domicile status. Residence is determined on each tax year, and domicile is a longer term concept, so it's really where you consider your permanent home to be. If you are leaving the UK permanently, you are likely to become non-UK resident, but your domicile status may require further review. So again, I would suggest that you do seek advice on that. It's also worth seeking advice abroad in the country that you are intending to move to. And the reason I say that is because depending on the sources of income that you receive, what you don't want to end up happening is for the UK to tax you on any income and for the foreign country that you're moving to also want to tax you on the same income. And fortunately, the UK has well over 100 double taxation treaties with other countries, which have been put in place exactly for this, to avoid double taxation. So the best advice I can give you at this point is seek advice before you leave. And there may be a couple of forms that need to be filled in. So for example, it could be that your pension income is actually no longer taxable in the UK, but that can only be determined by reviewing the treaty of the country that you are moving to and seeking advice in that country as well. Question number 5, if you have a business which you would like to exit, what do you need to consider? So this will very much depend on what you intend to do with your business once you retire. So perhaps you would like to close the business completely. Perhaps you would like to sell the business onto another third party. Perhaps you may decide to carry on the business, but on a much smaller scale. Or you may decide that you want to pass the business down to younger generations, maybe to children, family members, so that they can continue the business on your behalf. Whatever you decide to do, again, my advice here would be planning in advance is key, so that not only are you clear on what the progression plan is for the business, but there are a number of tax reliefs that you will be able to potentially benefit from. And to benefit from them, there will be certain conditions that need to be met. So, for example, just to give you one of the most common reliefs, which I see, is business asset disposal relief, where business asset disposal relief applies, a lower rate of capital gains tax of 10% applies rather than the higher rates of up to 28%, which is the maximum rate of capital gains tax payable. So it's worth looking at whether exiting your business will qualify for this relief, because it will result in you saving potentially up to 18% capital gains tax. We ran a series of webinars on exiting your business earlier this year in June, so I'm not going to say any more on it at the moment, but if you would like any further information, please do get in touch with us and we can send you the relevant information from our webinars at the time. Question number 6, and the final question, and the question which is probably one of the most important ones actually, is there any IHT planning that you can undertake to plan for your family's future, and what can you do? This is a huge area and is again very much dependent on your individual circumstances. So things for you to think about will be, where do you want to retire? Would you like to retire in the UK or abroad? Would you like to stay in your current home? Would you like to downsize? How much income will you need to retire comfortably? Would you like to make financial provisions for your family and friends during your lifetime? And how you would like your assets to be distributed on your death. You might think that it is still quite early to be planning, but it's always good to have it in the back of your mind. To give you a couple of facts, only 5% of UK estates pay IHT, and the other 95% don't pay IHT because the value of the estate falls within the tax-free nil rate band. The nil rate band is currently £325,000, so estates which are valued at less than £325,000 will not be subject to IHT. Any estate valued at more than £325,000 is subject to IHT at 40% on the value of the estate which exceeds the nil rate band. So it's very high, considering that you pay tax throughout your lifetime. Work hard, pay tax, and then on your death, there's still a further 40% to pay on any estate valued at more than £325,000. At the date of death, the estate will be valued, and this is known as the probate value. if I give you an example, actually, if you have an estate which is worth 1 million at the date of death, so £1 million, and assuming that the estate qualifies for the nil rate band, and assuming that there are no other reliefs available, the inheritance tax payable on that will be £270,000, which reduces the distributable estate from £1 million down to £730,000. So you can see immediately that a significant chunk of the estate ends up in HMRC's hands. With the right planning, you can reduce your IHT bill. And I'm sure most, if not all of you, would agree that you'd probably rather leave the money to your friends and family rather than to HMRC. So there is some planning that you can do just to make sure that you can bring your IHT bill down. There are a couple of other reliefs that you can use to help reduce your IHT payable. I'll just name a couple of the most common ones. So the main residence nil rate band can increase the nil rate band by up to £175,000. Any assets qualifying for what's known as business property relief will not be subject to IHT. And you can also transfer any unused nil rate band between spouses. So if the first spouse dies, if they don't use the nil rate band on their death, they can transfer that to the surviving spouse. In terms of the planning that you can do, there are two main areas. So the first one is lifetime planning, and the second one is provisions on your death in your will. So I'll just take you through lifetime planning now and a couple of steps that you can take to reduce your IHT bill. One of the main tools that you can use is what we call potentially exempt transfers, or I'll shorten it to PET. So where you make a PET and you survive 7 years from the date of the gift, that gift will then fall outside of your estate on your death. So PETs are quite useful if you want to give cash sums, or for example, for school fees, for university fees, if you'd like to help your children buy houses, cars. And as long as you survive 7 years from the date of the PET, then IHT will not be payable on that PET. You can also gift non-cash assets such as property, but then you need to consider capital gains tax as well. So you just need to take care with exactly the type of assets that you are giving away. A word of warning, please don't give away your main home to your children and then continue to live there. And that's a pitfall that quite a lot of people do tend to fall into. That's known as what's called a gift with reservation of benefit. So because you will be continuing to live in the home and benefiting from that asset actually won't be treated as having been made as a gift and will still form part of your estate at the date of your death. There are a couple of ways around that. So if you are thinking about giving away your main home, please again just ensure that you do seek advice before you do so. You can also use gifts out of income. This is quite a useful little tool which not that many people make the most of. So essentially with gifts of income, if you make regular gifts out of your income to anybody you like, really, and if you can demonstrate that the gift forms a normal part of your expenditure, so the same way that you pay your monthly bills, mobile phone bill, utilities, if you set up regular gifts to a family member or whoever you'd like to gift to, then the gifts will be exempt from IHT as long as you can demonstrate that making these gifts hasn't significantly reduced the quality of your life. You can also make the use of the annual exemption, where you can give away up to £3,000 per year free from IHT. And there are various other allowances such as marriage allowance. If there is a marriage, you can give away up to £5,000 depending on the relationship between you and the individual who's getting married. You have a small gift exemption where you can give away up to £250 to any recipient per tax year. You have a spouse exemption where gifts between spouses are tax-free, either during lifetime or on death. The exception to this is if one of you is non-UK domiciled, then slightly different rules apply. And finally, you can consider using a trust structure if, for example, you want to give away any funds or assets, but you would like a greater form of protection than just giving the fund or the cash or the asset outright to a family member. Perhaps a trust structure would be applicable in this circumstance. Quite frequently they are used if you are looking to gift to minor children. And then finally, if you are considering the provisions on your death in your will, my advice here would be please ensure that your will is up to date, and that's so that the assets, your assets, will be passed in line with your wishes at the date of your death. If you don't have a valid will at the date of your death, then your assets will pass in line with the laws of intestacy, which may not necessarily be how you would like your assets to be distributed. And a solicitor can help you draft up a will. Unfortunately, it's a legal matter and not something that I'm able to help you with, but please do ensure that you have one in place. So that's all for me. Thank you for bearing with me and my coughs throughout. Please do let me know if you have any questions.
Thank you, Marina. Now, as we're coming to the end of our webinar this morning, are there any questions from the audience? It's no worry if you don't have any questions right at this moment. If you think of any after the webinar, please don't hesitate to get in touch with either Prem or Marina. Here are their contact details for reference. They'll be happy to support you and answer any of your questions. So we have our first question. Is the state pension still rising every year in line with inflation for someone living abroad? I think that's a question for you, Marina.
I'm not sure, to be honest, is the answer to that. I'd need to double check and come back to you.
Thank you, Nikolai. We will come back to you with that. Are there any more questions, please? Okay, if there are no more questions, now I'd like to say thank you very much to our speakers today, Marina Trinchese from Rayner Essex and Prem Shergill from Growth and Wealth Management, for sharing your guidance around planning your retirement requirements and optimising your tax position. We'll now draw the session to a close. Remember, this session has been recorded this morning, so if you would like a copy of the video, please visit our website, growthandwealthmanagement.co.uk, or you can visit our YouTube channel. Thank you for attending this morning and enjoy the rest of your day. Goodbye for now.